You're watching a number on your screen that used to say $126,000. Now it says something closer to $60,000. 4 months, 50%, gone. And if you're like most people holding Bitcoin right now, you're asking yourself the same question everyone asks when markets do this. Is it over? Did I miss the exit? Should I have known better? Here's what nobody's telling you. This isn't the disaster you think it is. In fact, this might be the exact thing that keeps this cycle alive longer than anyone expected. I'm going to show you why what looks like a catastrophe might actually be the reset that prevents a much worse outcome. Welcome to Chart Chamber, where we don't just react to price action, we decode what it actually means. And today, we're going to walk through why the worst institutional exit since Bitcoin's inception could be setting up something far more interesting than another blown-out cycle top. Let's start with what actually happened. From early October 2025 to early February 2026, Bitcoin dropped from $126,000 to roughly $60,000. That's not a pullback. That's not a healthy correction in the way people like to use that phrase when they're trying to calm themselves down. That's a genuine structural move that erased 40% of the market cap in a matter of weeks. On October 10th, a $19 billion liquidation cascade sent prices from $122,500 down to $107,000 in hours. The market never recovered its footing. By January, Bitcoin had fallen for 4 consecutive months, a streak not seen since the pandemic crash. By the first week of February, the asset briefly touched levels below 70,000, revisiting prices last seen in November 2024. That single session on February 5th saw a 15% intraday drop, one of the bloodiest trading days in Bitcoin's history. The numbers tell a story of institutional retreat. CryptoQuant, the on-chain analytics firm that tracks capital flows across the crypto ecosystem, released a report in early February stating that institutional demand has reversed materially. Not softened, not paused, reversed. At this same point last year, spot Bitcoin exchange-traded funds in the United States were net buyers of more than 46,000 Bitcoin. In 2026, they flipped to net sellers, offloading roughly 10,600 Bitcoin. That's a demand gap of 56,000 Bitcoin compared to the prior year. Deutsche Bank analysts noted that these ETFs have seen billions of dollars flow out each month since the October downturn. More than $3 billion left in January alone, following $7 billion in November and $2 billion in December. The Coinbase Premium, a metric that compares Bitcoin prices on Coinbase versus global exchanges and serves as a proxy for American institutional demand, has stayed negative since mid-October. Historically, sustained bull markets coincide with a positive Coinbase Premium driven by strong United States buying. That dynamic is gone. But here's where it gets interesting. This isn't a blow-off top, and that distinction matters more than anything else. In 2021, Bitcoin rocketed from 29,000 in July to 69,000 by November. The parabolic move was fast, vertical, and fueled by retail euphoria. Social media was flooded with laser eyes and predictions of 100,000 by Christmas. Altcoins went ballistic. Meme tokens with no utility were doing 10x in a week. Momentum indicators like the monthly relative strength index were screaming overbought. That's what a blow-off top looks like. It's the phase where greed overtakes logic, where every dip gets bought instantly, where people who've never invested before are suddenly experts. And then it ends violently. The 2021 peak was followed by a 78% drawdown that took Bitcoin from 69,000 down to 15,000 by November 2022. That's the classic 4-year cycle playbook. Halving event, supply shock, parabolic rally, euphoric top, brutal bear market, accumulation phase, repeat. But 2025 didn't follow that script. For the first time in Bitcoin's history, the year following a halving finished in the red. Prices declined approximately 6% from the January open. The post-halving year, which had always been the golden window for returns, triple-digit gains in 2013, 2017, 2021, just delivered a loss. That's never happened before. And it's not because Bitcoin is broken. It's because Bitcoin has fundamentally changed. The asset that used to be dominated by retail speculation, by individual traders chasing hype on social media, is now an institutional portfolio mainstay. The launch of United States spot Bitcoin ETFs in January 2024 opened access to pension funds, asset managers, corporate treasuries, regulated long-term capital that doesn't panic sell on red candles. These institutions hold through volatility rather than react to headlines. The result is steadier, more persistent demand, but also a different cycle structure. The violent swings that characterized earlier eras, the 80% drawdowns, the 500% rallies in 6 months, those are being smoothed out. Which brings us to the uncomfortable truth. The absence of a blow-off top in 2025 might not be a failure, it might be an extension. Multiple analysts now argue that Bitcoin's 4-year cycle hasn't disappeared, it's stretching into 5 years. The traditional pattern was simple. A halving cuts Bitcoin's inflation rate in half, creating a supply shock. 12 to 18 months later, price reaches a cycle peak, driven by scarcity and speculation. Then comes the crash, the multi-year bear market, the bottom, and the slow climb back. But the April 2024 halving only reduced Bitcoin's supply growth from 1.7% to 0.85%. With nearly 94% of all Bitcoin already mined, each halving exerts less absolute supply pressure than the one before. The supply shock narrative, which worked brilliantly when Bitcoin was a $200 billion market, doesn't move a $2 trillion asset the same way. You need exponentially more capital to generate the same percentage moves, and that capital doesn't arrive on a halving countdown anymore. It arrives based on global liquidity conditions, Federal Reserve policy, real yields, risk appetite, the macro environment. That's why Bitcoin increasingly trades like a macro asset, correlated with equities, sensitive to interest rates, responsive to dollar strength. When the Federal Reserve was hiking rates aggressively in 2022 to fight inflation, Bitcoin fell alongside stocks. When global liquidity improved from 2023 into 2025, Bitcoin appreciated. The December 2025 Federal Open Market Committee decision projected only one rate cut for 2026, maintaining the target range at 3.25 to 3.5%. That's a tighter policy stance than markets had hoped for. And Bitcoin responded by selling off. But here's the key insight. The Federal Reserve is navigating a complex macro environment in 2026. Inflation is cooling but not dead. The labor market is softening. Unemployment is expected to rise toward 4.5%. Growth is moderating as consumer spending slows and fiscal support fades. The central bank is caught between controlling inflation and supporting employment. And historically, when the Fed pivots to prioritizing downside labor market risks, when they start cutting rates more aggressively to support growth, risk assets benefit. Real yields drift lower. Liquidity conditions improve. Capital flows into alternative assets with limited sensitivity to fiat debasement. Bitcoin, in this framework, isn't in a death spiral. It's in a reset. The October liquidation event and the months of selling that followed flushed out over-leveraged positions, cleared speculative excess, and forced a repricing of institutional expectations. CryptoQuant's data shows that Bitcoin has broken below its 365-day moving average for the first time since March 2022. Since that breakdown on November 12th, the price has declined 23% over 83 days. That's a sharper move than the early stages of the 2022 bear market, which saw only a 6% decline over the same time frame. The firm's Bull Score Index, which peaked near 80 when Bitcoin hit 126,000 in October, has now fallen to 0, the most bearish reading possible. Stablecoin liquidity is contracting. The 60-day growth of Tether's market cap turned negative by $133 million, the first contraction since October 2023. Long-term demand growth has collapsed 93%, falling from 1.1 million Bitcoin annually to just 77,000. All of that sounds catastrophic, but it's also exactly what happens before a cycle extends. Think about what didn't happen. Retail didn't show up. There was no mass euphoria, no mainstream media frenzy proclaiming Bitcoin as the future of money, no taxi drivers giving investment advice. Social media sentiment, which used to explode with overconfidence at tops, remained subdued. Fear and greed indexes spent most of late 2025 and early 2026 in fear territory, not greed. The options market tells the same story. In December 2025, Bitcoin's put-to-call ratio was heavily skewed toward calls, reflecting bullish positioning. By February 2026, that had flipped. The $75,000 put option became as popular as the $100,000 call option. Significant activity clustered around puts at 70 to 85,000, while demand for calls beyond 100,000 evaporated. Traders stopped asking how high can this go and started asking how low might it fall. That's not capitulation, that's pragmatic risk management. And it's exactly the kind of defensive positioning you see before markets find a bottom and begin the next leg. Now let's talk about what this means for the cycle structure going forward. If 2025 was supposed to be the blow-off year and it wasn't, then the peak might still be ahead. Some models projected a cycle top in late 2025, based on the halving plus 18 months framework. But if liquidity conditions were the bottleneck, if macro headwinds from higher rates and a strong dollar delayed the final thrust, then the timeline shifts. The Federal Reserve is ending quantitative tightening, the process of shrinking its balance sheet and draining liquidity from the system. Starting December 1st, 2025, the central bank halted the runoff of its securities holdings. The New York Fed launched a reserve management purchases program to buy Treasury bills, signaling a commitment to maintaining ample liquidity. Rate cuts are expected through 2026, with some analysts forecasting the federal funds rate near 3.25 to 3.5% by the first quarter of 2027. That's an easing cycle, and easing cycles historically support risk assets. The political calendar also matters. 2026 is a midterm election year in the United States. Governments, led by the United States, are advancing multi-trillion-dollar spending measures ahead of November. Elevated public debt is increasingly seen as constraining the Federal Reserve and raising the risk of quasi-quantitative easing delivered through administrative channels rather than conventional monetary policy. The combination of fiscal stimulus, confused monetary boundaries, and political pressure creates what some analysts describe as financial repression, a backdrop where borrowing costs are suppressed and financial conditions are managed through fiscal expansion rather than traditional tightening. That environment, where real yields are kept artificially low relative to growth and inflation, is structurally supportive for assets like Bitcoin that operate outside the fiat system. It's also worth noting that regulatory clarity is improving. The Securities and Exchange Commission has signaled movement toward clearer token classification frameworks. The Commodity Futures Trading Commission entered late 2025 with a digital assets pilot program permitting Bitcoin, Ether, and select stablecoins to be used as collateral. Public statements point to proposed rules addressing crypto trading on alternative systems and national securities exchanges, with guidance likely in early 2026. The crypto industry lobby has a war chest exceeding $100 million and a midterm election approaching. There's every incentive for United States lawmakers to deliver legislative outcomes that favor the industry. That's not a guarantee of higher prices, but it removes a major source of uncertainty that has weighed on institutional adoption. Meanwhile, on-chain data is starting to show signs of stabilization. After the brutal selling through late 2025 and early 2026, spot Bitcoin ETFs recorded over $560 million in net inflows on February 2nd alone. That suggests institutions are buying the fear at lower price points. Whale selling, which had been relentless, is decreasing. Addresses. Holding large amounts of Bitcoin are no longer dumping into weakness. The market is attempting to fill the CME gap, a technical level where Bitcoin futures traded during the week, but spot markets were closed, creating a price void that markets often revisit. These aren't definitive bullish signals, but they indicate reaccumulation rather than capitulation. Let's also consider what's different this cycle compared to 2021. In 2021, the Federal Reserve was starting to tighten. Rate hikes were on the horizon. Liquidity was peaking and about to reverse. That's a terrible setup for risk assets. The timing of the Bitcoin top in November 2021 coincided almost perfectly with the Fed's pivot toward hawkishness. In 2026, the setup is inverted. The Fed has already reduced rates by more than 100 basis points since September 2024. Another 25 basis point cut was widely expected. Rates are projected to continue falling. Quantitative tightening is over. Unlike previous peaks, where monetary policy was turning restrictive just as Bitcoin hit highs, this cycle is unfolding with the Fed in an easing mode. That doesn't guarantee a rally, but it removes one of the major headwinds that killed the last bull market. Another key difference is valuation. Bitcoin remains below its prior cycle highs when measured against the Magnificent Seven tech stocks. In 2021, Bitcoin's ratio versus those stocks hit 55. In late 2025, it was around 42. Against gold, Bitcoin traded at roughly 40 ounces near its 2021 level. In other words, Bitcoin has set new highs against the United States dollar, but not against key benchmark assets. That suggests there's room to run if macro conditions improve. The blow-off dynamics, the parabolic moves that signal a top, simply haven't happened. Volatility remains near historic lows, not highs. Sentiment is subdued, not euphoric. Those are conditions rarely seen at a true market peak. So what does all of this mean for someone holding Bitcoin in February 2026, watching their portfolio down 40% and wondering if it's over? It means you need to separate price action from cycle structure. Yes, the price crashed. Yes, institutions sold. Yes, the 4-year cycle as originally understood is broken. But broken doesn't mean dead. It means evolved. The cycle is stretching because Bitcoin is maturing. The supply shocks matter less. The macro environment matters more. And the macro environment, while challenging in late 2025, is setting up for potential improvement through 2026 and into 2027. Lower rates, expanding liquidity, fiscal stimulus, regulatory clarity, those are the ingredients that support risk assets. Bitcoin, as the largest and most liquid crypto asset, stands to benefit if those conditions materialize. The worst-case scenario isn't that Bitcoin crashed 50%. The worst-case scenario would have been Bitcoin going parabolic to 200,000 in late 2025 on pure speculation, with retail piling in at the top, with no institutional support, with the Fed tightening into the rally. That would have been a setup for an 80% crash and a multi-year bear market that destroys confidence for a generation. Instead, what happened was a correction that cleared leverage, reset valuations, flushed out weak hands, and created conditions for a longer, more sustainable cycle. The institutions that sold aren't gone forever. They're repositioning. They're waiting for clarity. And when they return, they'll return with the kind of capital that drives multi-year trends, not multi-month pumps. Think about the incentives at play. Corporations holding Bitcoin on their balance sheets, firms like MicroStrategy with over 650,000 Bitcoin purchased at an average price of $74,000 aren't selling into this weakness. They're structured to hold. Digital asset treasury strategies, which became popular in 2024 and 2025, are designed for long-term accumulation, not trading. These players provide a floor of demand that didn't exist in prior cycles. Meanwhile, the supply side remains constrained. Bitcoin's issuance is fixed. Roughly 19.6 million of the 21 million total supply has already been mined. New supply is minimal, and a significant portion of existing supply is held by entities that have no intention of selling. Wallets that haven't moved Bitcoin in over a year, so-called long-term holders, control a majority of the circulating supply. That creates a structural imbalance. If demand returns, even modestly, there's not much supply available to meet it. Prices adjust accordingly. Now let's talk about risk, because none of this is a guarantee. The scenario where Bitcoin extends the cycle and eventually makes new highs depends on specific conditions being met. The Federal Reserve needs to continue easing. If inflation reignites and the Fed is forced to hike rates again, that's bearish for all risk assets, Bitcoin included. Liquidity needs to expand. If fiscal policy tightens unexpectedly, if Treasury issuance creates term premium spikes that keep long-term yields elevated despite rate cuts, that's a headwind. Regulatory progress needs to continue. If lawmakers stall, if enforcement actions ramp up, if global coordination leads to restrictive frameworks, that's a problem. And geopolitical risks matter. Trade wars, conflicts, financial system stress, any of those can trigger risk-off moves that hit Bitcoin hard. The correlation with traditional markets, which used to be low, is now high. Bitcoin no longer offers the diversification it once did, and when stocks sell off, Bitcoin often sells off with them. But here's the framework for thinking about risk in an election year with changing Fed policy. Bitcoin isn't a safe haven, it's a risk asset. It thrives in environments of loose monetary policy, expanding liquidity, and positive risk sentiment. It struggles when policy is tight, liquidity is contracting, and investors are fleeing to safety. The current environment is transitioning from the latter to the former. That transition is messy, it's not linear, there will be setbacks. But the directional bias, assuming the Fed follows through on easing and liquidity conditions improve, favors risk assets over the next 12 to 18 months. Bitcoin, as the most established crypto asset with the deepest liquidity and broadest institutional acceptance, is positioned to benefit from that shift. The question isn't whether Bitcoin will recover, it's whether the recovery happens in 2026 or takes longer. And the answer to that question depends on how quickly macro conditions stabilize. If you're asking yourself whether you should have sold at 126,000, the answer is maybe. Timing tops is nearly impossible. Very few people sell the exact high. But if you're asking whether this crash means Bitcoin is dead, the answer is no. What it means is that the cycle didn't play out the way everyone expected. The blow-off top didn't happen. Retail didn't show up. Institutions got ahead of the move and are now resetting. And that reset, painful as it is, creates the conditions for what comes next. Healthy markets don't go straight up. They correct. They consolidate. They build bases. And then they move again. The 2021 cycle was too fast, too speculative, too unsustainable. The aftermath was brutal precisely because the top was so extreme. This cycle, by avoiding that extreme, might avoid the worst of the aftermath. There's also a psychological component worth considering. When prices crash 50%, the natural reaction is fear. You start questioning everything. Maybe I was wrong. Maybe Bitcoin isn't what I thought. Maybe I should just cut my losses and move on. And for some people, depending on their situation, their time horizon, their risk tolerance, that might be the right move. But for others, especially those who understand the long-term thesis, the crashes are opportunities. Bitcoin has crashed 70, 80, even 90% multiple times in its history. And every time, it eventually came back and made new highs. Not because of magic. Because the fundamentals, the fixed supply, the decentralization, the resistance to censorship, the utility as a savings technology, those didn't change. What changed was sentiment. And sentiment, by definition, is temporary. So here's the actionable framework. If you're holding Bitcoin through this, understand what you own. You own an asset with a fixed supply of 21 million units, roughly 19.6 million of which are already mined. You own an asset that operates on a decentralized network that has run continuously for over 15 years without a single hour of downtime. You own an asset that major corporations, asset managers, and even some governments are accumulating. You own an asset that thrives in environments of expanding liquidity and struggles when liquidity contracts. Right now, liquidity is in a transitional phase. It contracted through most of 2025. It's starting to stabilize in early 2026. If the Federal Reserve follows through on further rate cuts, if fiscal stimulus kicks in, if regulatory clarity improves, then the environment becomes supportive. And when the environment becomes supportive, the asset that got sold the hardest often rebounds the strongest. That doesn't mean you go all in. It doesn't mean you ignore risk. It means you think in probabilities, not certainties. The probability that Bitcoin makes new highs at some point in the next 12 to 24 months, assuming macro conditions don't crater, is higher than the probability that it goes to zero. The probability that we're in the early stages of a longer, slower cycle, rather than a dead cycle, is supported by the data. The absence of euphoria, the institutional reset, the evolving regulatory framework, the Fed's easing bias, the fiscal backdrop, none of those guarantee a rally, but they create a setup where a rally becomes plausible. And in markets, plausible is often enough. One more thing. If you're new to this space, if this is your first bear market, understand that this is normal. Bitcoin has always been volatile. The people who made generational wealth in Bitcoin didn't do it by buying at the bottom and selling at the top. They did it by holding through multiple cycles, through crashes that would have destroyed weaker hands, through periods of doubt and fear and uncertainty. They understood that the asset's long-term trajectory, driven by adoption, scarcity, and network effects, outweighed the short-term noise. That's not advice to hold blindly. It's a reminder that context matters. A 50% crash in an asset that's up 10,000% over a decade is not the same as a 50% crash in a failing company. One is volatility within a long-term uptrend. The other is a death spiral. Knowing the difference is what separates investors from gamblers. So yes, Bitcoin crashed 50%. Yes, it's painful if you bought near the top. Yes, the 4-year cycle, as we knew it, is broken. But the cycle isn't over, it's evolving. And the evolution, driven by institutional adoption, macro policy, and regulatory progress, is creating a different kind of market. One that's less explosive, but potentially more durable. One that doesn't rely on retail mania, but on steady, long-term capital allocation. One that might take longer to peak, but also longer to collapse. That's not the Bitcoin of 2013 or 2017. But it might be the Bitcoin that finally achieves mainstream acceptance. And if that's the trade-off, a slower cycle for broader legitimacy, then the crash we just lived through wasn't the end. It was the reset, the painful, necessary reset that clears the path for whatever comes next. If this breakdown changed the way you think about Bitcoin's price action, do me a favor and hit that like button. And if you want more deep dives into what's actually moving markets instead of just the headlines everyone else is repeating, subscribe to Chart Chamber, because we're going to keep following this story, tracking the data, and cutting through the noise to show you what's real. Thanks for watching.